In this video, I am going to discuss about relevant costs and irrelevant costs. If a cash flow changes because of a decision, it is a relevant cash flow. If not, it is an irrelevant cash flow, which means if a cash flow changes as a result of a decision, it is a relevant cash flow for that decision. If a cash flow is not changing as a result of a decision, it is not a relevant cash flow for that decision. Here what we do is we divide the future cash flows into two categories. One category is the relevant cash flows. The other category is the irrelevant cash flows. We only consider the relevant cash flows for the decision making. Irrelevant cash flows will be ignored under decision making. The term relevant costs also include cash inflows and cash outflows. This does not restrict to cash outflows. So when it comes to relevant costs, we also consider the cash inflows as well as the cash outflows. Cash flows can be both cash inflows, these can be revenue, or cash outflows, these can be costs. For short-term decision making, relevant cash flows are considered and irrelevant cash flows are ignored. These are the most common relevant cash flows and irrelevant cash flows when it comes to businesses. You don't have to remember all these cash flows by heart. You just have to have the understanding of what a cash flow makes a relevant or irrelevant cash flow. If the cash flow is changing as a result of a decision, it is a relevant cash flow. If not, it is an irrelevant cash flow. These are the common relevant cash flows you will come across in the context of business. Incremental costs. These are also known as the differential costs, opportunity costs, or lost contribution. Attributable fixed costs, specific fixed costs, avoidable fixed costs. Resale value or scrap value. This is also known as the salvage value. You will come across these irrelevant cash flows in the context of businesses. Sunk costs or non-recoverable costs, or also known as non-refundable costs. General fixed costs or unavoidable fixed costs. Committed costs, non-cash items, notional costs. Now let's discuss each cash flow one by one, so you will have a better understanding of what are these cash flows. First of all, let's discuss the items under relevant cash flows. Incremental costs, or also known as the differential costs. Incremental costs refer to the additional costs that are incurred as a result of a specific decision or course of action. These costs are relevant because they can help managers make better decisions by providing information about the true cost of a particular alternative. As an example, if a company is considering introducing a new product line, the incremental costs would include the cost of material, labor, and overhead required to produce the new product. Simply, these are the cash flows in the future that will increase as a result of a decision. Look at the given example here. If the company decides to introduce the new product line, the material, labor, and the overhead costs will be increased. So, these costs are relevant to the decision. Because of the decision, these costs will be increased in the future. Likewise, if any cash flow changes in the future as a result of a decision, those will be categorized under relevant cash flows. Those can be either cash inflows or cash outflows. Opportunity costs, or also known as lost contribution. Opportunity cost refers to the cost of foregoing the next best alternative when making a decision. In other words, it is the value of the opportunity that is lost when choosing one option over another. As an example, if a company is considering investing in a new project, it would need to weigh the expected return on investment against the opportunity cost of not investing in other potential projects. This is bit tricky to understand. Let me explain to you. Let's think a company has capital of 100,000 to invest in the new project, and there are three projects available: A, B, C. The company can only select one project out of these three projects. So they will conduct a investment appraisal techniques in order to find the expected return on each investment. Let's say project A will produce the highest return. Project C will return the second highest return. Lastly, the project B will return the third highest return. So the company will select the project A to invest. So they will invest their capital in the project A. Because of selecting the project A, the company has lost the opportunity to invest in the project C, because now the company does not have enough money to invest in project C because they already invested the money in project A. This is called the opportunity cost, because the company has lost the opportunity to invest in the next best alternative, which was project C. When it comes to decision making in the short term, opportunity cost will be considered as a relevant cost. This is not a cash inflow, this is a cash outflow, because this is a cost to the company. Opportunity cost can also apply to specific resources such as labor or materials. For an example, if a company uses a particular machine to produce one product, it cannot use the same machine to produce another product. The opportunity cost of producing the first product is the potential revenue that could have been earned by producing the second product. Let's say there is a machine A in a company. This machine can be used to produce two products. Let's say product 1, product 2. If the machine is used to produce product A, the machine cannot be used to produce product B. Because of that, the revenue from the product 2 will be lost. This is the lost contribution. Because we selected the product 1, we have lost the contribution of product 2. The basic idea of opportunity cost or the lost contribution is that losing the next best alternative when a decision is made. Attributable fixed costs, specific fixed costs, or avoidable fixed costs. Specific fixed costs are only considered if they are avoidable. Avoidable costs are costs that can be eliminated or reduced if a specific decision is made. For an example, if a company is considering discontinuing a product line, the specific fixed cost associated with that product line may be considered if they can avoid it by discontinuing the line. This means all the fixed costs that are specific to the decision can be treated as a relevant cost when it comes to decision making. Let's discuss about this example so you can understand what is a specific fixed cost. Let's say there is a production line in a factory. Let's say production line A. There are machines and employees are working in this product line. If the company decides to discontinue this product line, this means stop the operation of this product line, not the whole factory, just the product line A, so that the company can save the cost of paying managers wages, or employees wages. Managers and employees wages are fixed because every month they will be paid a fixed amount or fixed salary. So if the company decides to discontinue the production line A, these fixed costs can be saved. These costs are relevant for decision making. So always remember, specific fixed costs are relevant costs. And very important thing to note is that not all the fixed costs are relevant. They have to be specific or avoidable or attributable. Resale value, scrap value or salvage value. These terms can be used interchangeably, but these are little bit different from each other. Resale value is where assets can be sold to a new buyer so that the new buyer will use these assets for their intended purposes. Scrap value and salvage value is where the asset is being sold but those will not be used for their intended purpose. Let's say you have a bicycle. You decide to sell this bicycle and a new buyer will buy this bicycle for the intended purpose. This means to ride the bicycle, and that person will sell the bicycle in a later year to another person. Now the condition of the bicycle is very low, which means now this is not safe to ride. So the new buyer will scrap this bicycle for the material, which means to extract the metals and other recyclable materials. The price of the transaction is called the scrap value or the salvage value. Resale value or scrap value or salvage value refers to the potential value of an asset at the end of its useful life. This is a cash inflow, which means if you sell a bicycle, you will have a cash inflow. This is not a cost to you, this is a revenue. It is particularly relevant when considering the replacement of an existing asset or the disposal of an asset that is no longer needed. For an example, if a company is considering replacing an old machine with a new one, the resale or scrap value of the machine should be considered as a reduction in the cost of the new machine, which means there is a machine A. Now the company is deciding to sell this machine, let's say for $1,000. This can be the resale value or this can be the scrap value. This is a cash inflow to the company. Now the company decides to buy a new machine to replace the old machine, machine B, which will cost, let's say, $9,000. So the net cash flow of this transaction is 9,000 is a cost. So 9,000 is a cost to the company and there is $1,000 coming in because they sold the old machine. So the relevant cash flow of this transaction equals to 8,000. This is a relevant cost. Even though we do not use the parentheses, this is a relevant cost because the cost of purchasing the new machine is higher than the resale value of the old machine. So this is a relevant cost or a cash outflow. Now let's discuss about the irrelevant cash flows. Irrelevant cash flows will be ignored under decision making. Sunk costs, non-recoverable costs or non-refundable costs. All these terms are describing the same cost. In relevant costing, some costs are costs that have already been incurred and cannot be recovered and therefore they should not be considered in the decision making process, which means we do not consider some cost under decision making. This is because some costs are not relevant to the current decision being made and are not affected by any decision made in the future. For an example, if a company has paid 10,000 to a research firm to conduct a market research of the reaction to a new product, the $10,000 is a sunk cost because it cannot be recovered. If the company decides not to launch the new product, the 10,000 should not be considered in the decision making process because it has already been incurred and cannot be recovered. This is the important part. Sunk costs cannot be recovered because they have already incurred. Any cost that have been already incurred will not be considered under decision making. These are irrelevant to the decision making. Look at the given example here. A company has paid 10,000 to a research firm to conduct a market research. Whether the company decides to launch the new product or not, this 10,000 will not be recovered. So that this will become a sunk cost. When it comes to decision making, this 10,000 will not be considered. General fixed costs or unavoidable fixed costs. Unavoidable fixed costs are fixed costs that cannot be eliminated or reduced in the short term, regardless of the decision being made. These costs are typically associated with the production and operation of a business, such as rent, property taxes, and insurance premiums. In relevant costing, unavoidable fixed costs are not relevant to the decision making process because they are not affected by the decision being made. Simply, these are the fixed costs that cannot be avoided. In other words, these fixed costs are incurred for the whole organization or for the whole company. A good example is rent. Whether the business operates in a month or not, they have to pay the rent because the rent is a fixed cost. This cannot be avoided. So these kind of unavoidable fixed costs or general fixed costs are ignored under decision making because the decisions being made will not affect the unavoidable fixed costs. Committed costs. Committed costs are costs that have been committed to and cannot be changed in the short term regardless of the decision being made. These costs are typically associated with long-term contracts or agreements, such as lease agreements or long-term supplier contracts. In relevant costing, committed costs are not relevant to the decision-making process because they cannot be changed in the short term. Simply, these are the costs that a company has to be paid in the future, such as lease agreements. They have to pay the lease payments or the long-term supplier contracts. The company has to pay the suppliers. They cannot avoid these costs. They are committed to these costs. Wages of the employees. These costs are also a form of committed costs because the company has to pay their employees in the future. So when it comes to decision making, committed costs will not be considered. They will be ignored. The reason is that the decision is being made will not affect the committed costs. Non-cash items. Non-cash items such as depreciation or amortization are generally not relevant to short-term decision making in relevant costing. These are accounting cash flows and not actual cash flows. This is because they do not involve actual cash flows and do not affect the company's immediate cash balance. Amortization is also a type of depreciation. So when it comes to decision making, non-cash items will be ignored. Notional costs. Notional costs are hypothetical or imaginary or estimated costs that are used for internal management purposes, such as budgeting, forecasting, or cost analysis. They do not represent actual expenses incurred by the business and are not recognized as expenses in the financial statements. These are the imaginary or hypothetical costs which have no real monetary value. Let me give you an example. Let's say there is a company A. Company A has a headquarters in city 1 and there is a factory in city 2. The headquarters building in city 1 is owned by the company A, but the factory in city 2 is rent by the company A, which means the company has to pay rent every month. At the end of the financial year, the management of the business will consider a notional cost for the rent for headquarters in City 1, even though there is no such cost. This is purely to compare the profit of headquarters and the factory because the headquarters does not have a rent value. In order to compare these two values, the management will come up with the notional cost for rent in City 1. These notional costs will not be considered under decision making. Only real cash flows will consider under decision making. Decision making using relevant costing. NPV technique. Under NPV technique, we calculate the present value of future cash flows. Under this technique, we only consider the relevant cash flows. The irrelevant cash flows will be ignored. Make or buy decision. Limiting factor analysis. Minimum pricing. Discontinuation decision. Joint product further processing decision. All these techniques will use the relevant costing method, which means only the relevant cash flows will be considered under each technique. The irrelevant cash flows will be ignored. Let's do this example so you can understand what we have learned so far. Company A considering an initial investment of 50,000 for a new project and the project will return 12,000, 13,000, 15,000 in year 1, year 2 and year 3 respectively. A research cost of 1,000 was paid to a research firm. The machinery for the project will depreciate by 500 annually. Annual wages for the staff is 15,000. At the end of year 3, the machinery can be sold for 3,000. What are the relevant cash flows for the NPV calculation? So first what we have to do is we have to identify what are the relevant cash flows and what are the irrelevant cash flows. Let's take one cash flow at a time. The initial investment of 50,000. Is this a relevant cash flow or not? This is a relevant cash flow because this cost will be incurred if the company decides to invest in the new project. So this is a relevant cost. We will consider this cost for the NPV calculation. And they have given the return for year 1, 2 and 3. All these cash flows are relevant because these are future incremental cash flows, which means if the company decides to invest in the new project, these cash flows will be raised. So these cash flows will be considered under NPV calculation. And they have given a research cost of $1,000. This is not a relevant cost because this cost is already been incurred. This is a sunk cost. So we do not consider $1,000 for the NPV calculation because for the NPV calculation we only consider the relevant cash flows. And they have given a depreciation amount $500 annually. Do we consider this cost under NPV calculation? No, we don't because this is a non-cash item. We do not consider non-cash items under NPV calculation because non-cash items are irrelevant and they have given the annual wages for the staff is 15,000. Is this cost relevant or not? This is also not relevant because this is a committed cost. Company has to pay the wages to their employees. The company is committed to pay these costs. So this cost is irrelevant. We do not consider this cost under NPV calculation. Finally, they have given the resale value of a machine. Is this cash flow relevant or not? This is relevant because this is a resale value. In the future, this cash flow will incur. This is a cash inflow. I hope now you can understand how to identify the relevant costs and irrelevant costs. Relevant costs are the costs that will be changed as a result of a decision being made. On the other hand, irrelevant costs will not be changed as a decision being made. Now let's discuss about this example. Company A has purchased a machine 6 years ago for $80,000. The machine has an annual depreciation of 600. They are considering to replace the old machine with a new machine which will cost 95,000 and the scrap value of the old machine is estimated to be $2,000. What is the relevant cost if the company decides to purchase the new machine? Now let's consider each cash flow one by one. They have bought the machine 6 years ago for 80,000. Is this cash flow relevant or not? This is not relevant because this is a sunk cost. The company has already paid this amount 6 years ago. So we do not consider sunk costs under relevant costing. The machine has an annual depreciation of $600. Is this cash flow relevant or not? This is not relevant because this is a non-cash item. Non-cash items are irrelevant when it comes to decision making. And they have given a replacement cost of 95,000. Replacement cost means they will sell the old machine and buy a new machine. The price of the new machine is the replacement cost. So this is relevant because in the future this will incur. This is a cash outflow. So the relevant cost equals to 95,000. We do not use parentheses or negative value because we are going to calculate a cost, which means this is already a negative value. If we were to calculate the relevant cash flows, then we have to use the plus and minus values. Minus values for costs and plus values for revenue. Then they have given the scrap value of the old machine, which means the old machine can be sold for $2,000. This is a relevant cash flow. This is a cash inflow. So we will consider this cash flow under relevant costing. Since this is a cash inflow, we use a minus value. So the relevant cost of this decision is 93,000. This is a relevant cost. That is why we do not use the negative sign or parentheses. Cost implies that this is already a negative value. We use a negative value here because this is not a cash outflow. This is a cash inflow. This is because this is a relevant cash inflow. I hope now you understand the concept of relevant costing. When it comes to management accounting, relevant costing is very important. This method will be used under different techniques when it comes to decision making. Thank you for watching. See you in the next video.